Thank you for joining today's EU Mandatory Disclosure Regime webcast. Your moderator for today is Ms. Marlies de Ruyter. Ms. de Ruyter, you may begin.
Thank you very much, and welcome everyone. We're very glad you could join us today for our Global Thought Leadership webcast on the new EU Mandatory Disclosure Rules. As said, my name is Marlies de Ruyter. I'm EY's Global International Tax Policy Leader, and I will be your moderator today. So before turning to our topic, there's a little webcast housekeeping to take care of. First, I would like to let you know that we will be taking questions throughout today's session, and you can use the red Q&A tab at the bottom of this interface where you can send your comments and questions to us. As a second, you can download a copy of the slides for today's program, and to do this, click on the green folder icon at the bottom of your interface. And finally, there will be polling questions that appear throughout this webcast. You'll need to respond to them in order to qualify for CPE or CE credits. So if education credits are important to you, please keep an eye on your screen for these polls and answer to them. We will not have time to comment on most of the outcomes, I suspect, because there's a lot to cover, but we will show the results on the screen. So for today's webcast, we do have a very good global panel for the discussions. So joining me today are Tom Ralph. Tom is a U.S. native. He's resident in Munich, Germany, and there he is a member of EY's U.S. Transfer Pricing Desk. So welcome, Tom.
Thank you.
As a second, we have as a second, we have Hanno Bustos. He's currently leading the BEPS desk in the EU Global Desk Network in New York. And welcome to you too, Hanno.
Hello, Marlies. Nice to be here with you.
So as a third, we have Stephanie Lamb, and she is one of the leaders of our financial services practice. Welcome, Stephanie. And finally, but definitely, oh, sorry, Stephanie, I'm too quick. So finally, but definitely not kind of least, we have Rink Kamphuis. He's one of the leaders of our tax technology and transformation practice. Welcome, Rink.
Hi, Marlies. Good to be here.
So that's our panel for today, and today is our first webcast on a very new topic, on the new and quite challenging mandatory disclosure rules, and the EU is imposing those on tax service providers, but also on taxpayers. We want you to be aware of the impact of these rules because they will be quite severe. So you are looking now at the agenda for the hour that we have today. It's important to note that there are still many aspects of these rules that need further clarification, and not by any means do we all have all answers today, or maybe we cannot even answer some of the questions that seem very obvious. Therefore, there will likely be further webcasts on this and updates as additional guidance from both kind of the EU member states and the EU come available. But before we go into the content, let's first have a polling question to see what the general level of awareness is of the new directive setting out these mandatory disclosure rules. So if you look at it, so what is your understanding of the content and the impact of these new rules? The answers are on your screen. Please select one, and the results will appear later on. So now on content. On March 13, the EU Council reached agreement that so-called tax intermediaries, which in their press release they summarized as tax advisors, accountants, and lawyers, they need to report, and again I use the words that the EU uses in its press release, schemes that are considered potentially aggressive. Well, as we will discuss in this webcast, a more thorough reading of the directive, however, makes it very clear that the term intermediaries is quite broad, potentially including also banks and trusts. This obligation to report will also shift to taxpayers themselves if there is no EU intermediary that is obliged to report. So also we will see that the net to catch what is considered aggressive cross-border tax planning is cost actually vary widely. So some of these things will not everyone consider as aggressive tax planning. Moreover, once the report has been made, it will automatically be shared between the tax authorities in the EU. So there will be automatic exchange of information. The broad scope is consistent with the aim of the directive, which is to tackle what the EU sees as aggressive cross-border planning. The directive achieves that in two different ways. First of all, by providing tax authorities with information about the types of tax arrangements that may be out there, but also they are trying to create a behavioral change. Deterrent for taxpayers to engage in engagements that could draw the attention of the tax authorities once reported. Of course, the first question to ask when we're talking about these new rules, in particular because they were only very recently adopted, is so when will they start to have an impact? So Stephanie, even though the reporting isn't required until 2020, my understanding is that the application of the rules is very imminent. Is that right?
Yes, Marlies, that's absolutely right. And that's because the directive asks EU member states to give retrospective effect to the rules when they implement them. So let me explain that in a bit more detail. The amendment to the Directive on Administrative Cooperation in the field of taxation, which is what we're talking about, will likely enter into force, we expect, around June or July of this year. As you said, on March the 13th, political agreement was reached on the text of the directive. And at the moment, it's being translated into all official languages. Once it has been translated, it will then be formally adopted, likely at the May ECOFIN meeting. A couple of weeks after that, it will be published and it will enter into effect 20 days after official publication. So taking all of that together, as I said, it will be likely sometime during the summer. The member states then translate the directive into legislation before the end of 2019, and the legislation will have to take effect as of July 2020. However, as I said, there is the obligation to create a retrospective effect for reportable cross-border arrangements where the first step was implemented after entry into effect of the directive and before July 1st, 2020. Reporting will have to take place before August 31st, 2020, and after that, the first exchanges of information will take place in October 2020. So given the steps to take place until official adoption, we therefore expect that the scope of this directive will include reportable cross-border arrangements implemented as of June, July this year.
Hey, that clarifies, Stephanie. So that means it will be crucially important to be able to identify these reportable cross-border arrangements actually as of kind of July this year, which is in 2 months or so. Penalties will apply, as we've heard, on situations of non-compliance. So in order to understand what needs to be reported and who needs to report, let's first take a look at the overview of the process that is reflected on the next slide. So as you see, the whole process starts from the indication that something may be changing in the tax environment of kind of a person or a company. That could even be the entrepreneurial or a personal environment of that person if it has tax consequences. So as I said, this person may be an individual or an entity. And such a change may be a planning activity that is, for example, needed because of a new market development or a restructuring of activities or maybe even a reshuffling of entities. And the creation of new contracts and transactions is also captured. Once you have established there's something new like this, the first question is whether the taxes that may be implied are in scope. And once the answer on that is yes, then it needs to be assessed whether the change leads to a cross-border arrangement. Again, if the answer on that is yes, we will need to assess whether the arrangement is reportable. And an arrangement will be reportable if it meets one or more of the predefined hallmarks. Once it is established that there is a reportable cross-border arrangement, Then the next thing to establish is who needs to report, which could be the intermediary, or if there is no intermediary in the EU that is obliged to report, it may be the taxpayer. And finally, when it's established who needs to report, then the next questions are what information needs to be reported, and when it needs to be reported, and where it needs to be reported. So this slide gives an overview of that process. So during this webcast, we will walk through all these different steps. So let's however first take our second polling question, in which you can give your initial reaction to the directive. So what is your initial reaction looking at what you've heard so far? Please select the answer that is most appropriate for your case. So now let's move back to the first step of the process. And the first question to ask is what taxes are covered? So Stephanie, can you shed some light on that?
Sure, Marlies. So the existing directive into which the new rules are being included is one that relates to all taxes, although it does specifically exclude many indirect taxes. So income tax, corporate tax, capital gains tax, registration duties, things like local taxes, real estate taxes, wealth or inheritance taxes are all within scope. But indirect taxes, so VAT, customs and excise duties, they're out of scope. Also, social security contributions, fees for certificates, etc., and dues of a contractual nature are also excluded.
Yeah, thanks, Stephanie. So that limits actually the application more or less to direct taxes, and that has been confirmed also by the press release accompanying this directive. So when we know kind of which taxes are in scope, the next question is whether the change may lead to a cross-border arrangement. So Tom, what is exactly a cross-border arrangement according to the directive?
Well, Marlies, I think it's important to note right up front that many of the concepts that we'll be diving into now are vague and require interpretation. In concept like cross-border arrangement, guidance on how to interpret certain terms isn't available yet, and it's likely to be written only sometime next year when the governments start to introduce these rules into their own domestic legislation. I think it's also important that countries may deviate from the directive and be even stricter than the language in the directive, for instance, by including domestic arrangements in their requirements. But at the moment, we can only work with the information we have, and as mentioned, due to the retrospective effect of the directive, we'll need to start collecting information on cross-border reportable arrangements that are subject to the directive as of this coming June and July. So the first relevant question is, on a cross-border arrangement, is what exactly is an arrangement? That's a tough one to answer. The directive says an arrangement can consist of more than one step or part. However, more explanation really isn't given. So if we look at some of the accompanying publications, and if we look at the way some countries, such as the UK, have already implemented mandatory disclosure rules, one can see that an arrangement, probably interpreted as anything from a transaction to a series of transactions, a structure, or a scheme. So, as you can see on the slide here, an arrangement is regarded as a cross-border arrangement when it concerns more than one of the EU member states or a member state and a third country. So, transactions between Australia and China are clearly out of scope. But to be of concern to one or more states, as required, one of the conditions on the slides needs to be met. You see the list of them. Any arrangement that involves participants from more than one country will be captured, clearly. And as you see, these participants do not necessarily have to be associated enterprises. So that condition is quite easily met in a cross-border situation. The other conditions are more specific and require either a participant that is a dual resident or has a permanent establishment, or, and this is really quite far-reaching, concerns a situation where a participant carries on an activity in another jurisdiction without being tax resident or creating a permanent establishment. And that's really quite mind-boggling. So this could mean that if a sale of goods is considered an activity, or simply traveling to an EU country for business purposes is considered an activity, then such activities are a cross-border arrangement and may be caught up as a reportable arrangement if one of the hallmarks is met. So obviously this raises the key question as to whether and which hallmarks may be met in these situations. So also arrangements that have an impact on automatic exchange of information or the identification of beneficial ownership are captured.
Yeah, Tom. So that means actually that the definition of cross-border arrangement may capture many situations. So I'm thinking about, for example, a professor traveling to another country to give a lecture, or an employee of a small or medium-sized enterprise traveling to another EU member state to explore the possibility in that market by participating, for example, in an industry fair. So the key will then be whether there is a reportable cross-border arrangement, if I understand correctly. So what makes a cross-border arrangement reportable?
Well, you're right, and that's important. That it has to be reportable, and so a cross-border arrangement that's subject to reporting occurs only when they meet one of the hallmarks, which are designed to reflect characteristics of arrangements which are deemed to create potential risks of tax avoidance. These hallmarks are not carved in stone. They will be reviewed every 2 years, and they may change with time. But when looking at the hallmarks, and we'll look at them in a little more detail as we go through the presentation, it's also important to recognize that some hallmarks are subject to a gateway criterion, and that being the main benefits test, and some are not. So the main benefits test resembles the main purpose test that we see in general anti-avoidance rules, or the principal purpose test that the OECD has developed. However, the main benefits test relates only to the benefit created by the tax advantage, and not the purpose behind the arrangement. So it seems to be intended to be broader than the main purpose test. Besides that, the test seems intended to be more objective, looking at the weighting of the expected tax advantage compared to other expected advantages. The problem is that there isn't clarity around what the tax advantage is, or when a tax advantage is considered to be derived. So what is the starting point or the counterfactual from where the assessment begins? Well, the only sliver of explanation is given by the wording that is added for the Category C hallmarks, which are the subject of the main benefit test. And if we look at that, there we see that taxation at a zero or almost zero corporate tax rate, the applicability of a full exemption, and the taxation in the context of a preferential regime by themselves are not sufficient to conclude that there is a main benefit. So this implies that a counterfactual first needs to be defined before it can be assessed whether a tax benefit was actually derived. And this counterfactual could, for example, be the arrangement, a series of transactions as it would likely be constructed if no tax would be imposed. So this would, for example, mean that a commercial activity of a company in a zero tax country by itself should not lead to reporting.
Thanks, Tom. So if I understand correctly, the hallmarks play an important role in the determination of whether a cross-border arrangement will be reportable. And that leads to the question about the professor that I just asked. So the professor, will he be captured by the hallmarks? So looking at the slide that is on now, that one reflects all the hallmarks. And as you see, the hallmarks illustrate how broad the scope is the EU has captured. The first box relates to hallmarks for which the main benefits test functions as a gateway criterion. The hallmarks indicated in the second box will trigger a reporting requirement by themselves, so even without the main benefits test. As it takes too much time to discuss all of the hallmarks because there are many, we will discuss some now, but the overview on the slide gives you an indication of the many elements that may be captured. And we do have also a polling question on that. So what do you think of the scope of the hallmarks? Is it too narrow, about right, or too broad? Please select one of the answers on your console, and we will come back to the answers later on. In the meantime, we will move to a more detailed discussion of some of the hallmarks. And before I give the word to Hanno, I would like to start with a short comment on the confidentiality hallmark, which is the first one. And this is one that I think taxpayers may want to pay very special attention to, because such confidentiality clauses are actually quite commonly posed by intermediaries giving tax advice. EY actually changed its approach globally following the introduction of mandatory disclosure rules in the US, and we don't have those conditions anymore. But my expectation is that the introduction of mandatory disclosure rules in Europe may have similar effects on the engagement conditions on tax advice in the EU. So Hanno, the confidentiality hallmark looks at formal agreements between the client and the intermediary, but many others look at triggers that are closely connected to the amount of tax to be paid. Can you give a couple of examples on that?
Yeah, sure, Marlies. Thank you. Yes, let me for that briefly describe some of the so-called specific hallmarks related to cross-border transactions. As we see, these are the ones included in letter C, paragraph 1 of the annex of the directive that we've mentioned. And as Tom just referred to, some of these hallmarks require the main benefit test to apply, and others don't. So, and we'll go through this in a minute. But if we look at the common elements of these hallmarks included in this piece of the directive, it's interesting to note that all of them relate to arrangements that involve deductible payments between associated enterprises. Therefore, with this, not all cross-border payments are included, but only the ones that are deductible. So, and these payments as well need to be made between related parties, and this is a term that is precisely defined in the directive. So we need to look at that definition in order to see what is a related party for the purposes of this directive. But the payment don't need to be between member states, and payments involving third countries are also covered by the directive. So once we have a payment that meets these conditions, as I said, basically being a deductible payment and between related parties, then the hallmark then looks into, and as you said, Marlies, the tax consequences of the payment for the recipient. And here the directive is clearly looking into situations where there is a deduction with a non or low inclusion on the other side of the transaction. If we look at the different hallmarks included in this letter, the first case that we see is that when the recipient is not resident for tax purposes in any jurisdiction. This, for example, can happen when transparent entities are involved in the transaction. But the hallmark, this particular one, does not require the main benefit test to be met. So clearly, the mere fact of a deductible payment being paid to such transparent entities, for example, would trigger the reporting obligation under the directive. So There are also, as you'll see, two other hallmarks that look into the characteristics of the jurisdictions where the recipient of the payment is established. First, we have payments to jurisdictions that do not impose any corporate tax, or even if they do have corporate tax, the corporate rate is zero or almost zero. So these hallmarks, as it is drafted, seems to refer to the statutory rate of the jurisdiction and not to the effective rate of that jurisdiction to make this determination. In this particular case, as we said, the main benefit test needs to be met. The other hallmark that looks into the jurisdiction where the recipient is resident is the one that refers to non-cooperative jurisdictions. Those are the ones included in OECD or the EU list, the so-called black list. You may remember that the EU published this list last year, and this directive in fact is making use of this new list of the EU. Well, in these cases, there is no requirement to meet the main benefit test, and therefore the hallmark will apply automatically when payments are made to any of these listed jurisdictions. Then the two other hallmarks included in this letter C1 don't really look into the features of the jurisdiction of the recipient, but rather the taxation of the payment itself. In both cases, the main benefit test needs to be met, and I think it's important to note here that the directive makes it clear that in the context of the application of these specific hallmarks, the presence of the conditions sets out in them, which in this case is basically the low taxation in the hands of the recipient, cannot alone and by itself be a reason for concluding that the arrangement satisfies this main benefit test. So when we're looking at these two hallmarks, the first one we have is the one that is looking into payments benefiting from a full exemption in the recipient's hands. So therefore, not partial exemption, need to be full exemption in order for the hallmark to apply. And the other case would be that of payments benefiting from a preferential tax regime. And I find this very interesting because any preferential tax regime, not necessarily harmful, would be covered. So, for example, if those tax regimes like patent boxes that may meet the recommendations of the OECD under the BEPS project may still fall within the scope of this hallmark. And if we look at the OECD definition, a regime may be considered preferential if it offers some form of tax preference in comparison with the general principles of taxation in that particular country.
Yeah, thanks, Hanne. So now let's move to the area of financial services and beneficial ownership. So Stephanie, can you tell us something about the hallmarks on exchange of financial account information and unclear beneficial ownership structures?
Sure, Marlies. So these are contained within letter D of the annex. D1 is targeted at arrangements which, and I use the words carefully, may have the effect of undermining the reporting obligations under the Common Reporting Standard, often referred to as CRS. So there's a couple of points there that to draw out. First, on the face of it, it's really, really broad, as it doesn't necessarily need to have had the effect, but simply may have the effect of undermining the CRS. And secondly, I think it's interesting they use the word undermine, which seems to introduce an element of intent and subjectivity, which will clearly going to need some guidance on in order to understand where the bar is set and enable the filtering of arrangements which are purely commercial, so those that result in no CRS reporting, but that's quite simply the outcome of a commercial arrangement, rather than something that's being used purposefully or for the purpose of avoiding CRS reporting for improper purposes. In the guidance, specific examples of arrangements are included, but it's noted that it's not an exhaustive list. So, for example, they say that arrangements to transfer funds outside the scope of CRS reporting by moving an account from a financial institution in a CRS participating jurisdiction to a financial institution in a non-participating jurisdiction. They also include the use of financial investments or products that fall outside the definition of a financial account, which is a defined term, however, which has features which are substantially similar to those of a financial account. They would also be there. It's also interesting to note that the introduction to the proposed changes to the directive do make reference to the work that's been undertaken by the OECD on the model mandatory disclosure rules for addressing CRS avoidance arrangements and opaque structures, what I'm going to call here the MMDR to try and distinguish it. And it cites the MMDR in its commentary as a good source of illustration and interpretation around this particular hallmark. So what does that really mean for financial institutions? Here it's necessary to go back, I think, to the definition of intermediary that we started off with. So the definition of intermediary is really broad. It doesn't just include persons responsible for the design or marketing of arrangement, but also includes any persons who provide services, assistance, or advice relating to the design, marketing, or organization of the arrangement when they know or could reasonably be expected to know that the person was involved in such an arrangement. So unpacking that a bit more, the definition generally wouldn't be expected to capture financial institutions when they're carrying out routine banking transactions, so money transfer and custody, etc., simply because the nature of the information readily available to those individuals wouldn't typically meet the reasonably be expected to know standard. However, I think financial institutions will need to consider the services they offer and whether there are instances in which they're in possession of knowledge using that objective standard, which would mean they should know that their services cause them to be an intermediary with a potential obligation to disclose. So financial institutions may need to consider just undertaking risk assessments to really think about and identify those areas of their business where such arrangements might exist. So that was Hallmark D.1. The other Hallmark, D.2, specifically targets arrangements which involve a non-transparent legal or beneficial ownership chain. So it applies to any arrangements that meet certain conditions regardless of the purpose or effect of those arrangements. So an arrangement is caught if it involves a non-transparent legal or beneficial ownership chain and also uses persons, legal arrangements or structures that meet the three conditions that are set out there on your slides. The MMDRs, so the OECD document I referred to earlier, that does actually have a fuller definition of an opaque offshore structure and an exclusion for institutional investors, meaning regulated and government investors. And the MMDR refers to Financial Action Task Force transparency requirements as well as a test of whether a jurisdiction is sufficiently transparent. So further guidance can be found there.
Yeah, and many thanks for that explanation, Stephanie. So that kind of gives an insight on kind of what it could mean for financial institutions, for example. So that moves us to the e-hallmarks, and the e-hallmarks are on transfer pricing. And for me, these illustrate how broad kind of the impact may be. That is maybe also a good time to go to our polling question on that. And I think we have it's interesting. We have a split here because 40% of the people think that the scope is way too broad, while 22% of the people think it's too narrow, actually. So let's see what Tom thinks of this. So Tom, what do the the transfer pricing hallmarks, what do they say?
Marlies, the first specific hallmark related to transfer pricing involves the use of unilateral safe harbor rules, and these are something that the OECD has been considering, and I think even encouraging. And some countries, such as Brazil and even the U.S., at least for some services transactions, have transfer pricing rules that don't follow OECD norms or don't follow the full arm's length standard. Rather, these rules compensate related parties by using specific fixed margins depending on the industry. A good example is with Brazil, they generally require the use of the resale price method, with respect to the importation of goods, services, or certain rights. And using this method, the Brazilian entity must earn a specified minimum statutory gross profit margin, and it ranges from 20% to 40%, depending on the company's industry. Similarly, for exported products or services, the Brazilian entity must earn a minimum of a specified fixed statutory profit margin. And they have kind of a similar concept with limiting deductions of interest expense that Brazilian entities pay when they pay interest to foreign-related parties, and there's a reference to LIBOR plus an annual spread. And perhaps a slightly different example is the U.S. offers taxpayers the ability to depart from the arm's length standard and charge only costs for certain services that are generally administrative or low value in nature. And that's through the use of the services cost method. And you may have heard of that because it's attracting more attention lately because of the use of it may help mitigate the impact of the new base erosion anti-abuse tax, the BEAT tax, that was introduced in the U.S. A few months ago. So looking at these unilateral safe harbors, presumably related party transactions with Brazil that use the statutory minimum profit margins or statutory interest rates would need to be disclosed. And similarly, transactions with U.S. related parties that use the services cost method would need to be disclosed as well. So these are just a couple examples. Many similar unilateral safe harbors exist, and even though these transactions clearly pose a risk of charging prices that aren't arm's length, you can question whether all of these would pose really a relevant tax risk to the fiscs of the various nations. Generally, safe harbors are intended to create a simplified approach for relatively routine, low transfer pricing risk transactions. And so, to me, it's a pity that now the flavor is given that all transactions falling within the scope of this hallmark are potentially tax avoidance practices, and particularly in a time when simplification is so badly needed in our transfer pricing world. So another example is that taxpayers also need to disclose information about transactions involving intangibles that are hard to value, perhaps because of the lack of comparables or due to difficulties in predicting at the time of transfer the level of ultimate success of the intangible or things along that line. So although the transfer of the IP may be done for non-tax reasons, the new mandatory disclosure rules require these types of transactions to be disclosed. How will governments use this information? Will they look at all these kinds of transactions as nefarious? Well, time will tell, but I think the message we can take from this is that it's advisable to ensure that you have a robust functional analysis, a robust economic analysis, and document all reportable transactions. Similarly, transactions involving restructurings that result in significant profits shifts following the transfer of functions, risks, or assets between jurisdictions must be reported. I mean, take the simple example of converting from a full-fledged distributor into a riskless distributor, and consider the example in which a multinational enterprise group, an M&E, holds trade names and other similar IP in Company A, we'll call it, and long-term supplier contracts in Company B. After the M&E group acquires a full-fledged distributor target, the M&E group transfers the acquired corporation's trade name and similar IP to Company A, and the acquired company's long-term supplier contracts to Company B, consistent with its corporate strategy for operating in other situations. Well, this example may sound familiar because it's an example from the OECD transfer pricing guidelines on restructuring. And the OECD transfer pricing guidelines instruct us that such a restructuring would be respected. But nonetheless, the new mandatory disclosure rules require that transactions such as this must be disclosed even if an exit tax is paid. So again, it's unclear how governments will use this information they receive under the new rules. So I think it's critical to ensure that the conduct of the parties is consistent with the form of the restructuring, and that the economic analysis is strong, and that the documentation supporting that is strong as well. So, to me, the new mandatory disclosure rules imply that taxpayers must be even more proactive in performing functional and economic analyses and documenting their transactions.
Thank you very much, Tom. And it seems that that actually, kind of listening to you, that your opinion is aligned with one of the comments we received, saying, what are the governments going to do with all this information? And also to keep in mind that for many of these transactions, there may not even be an intermediary involved, and then, of course, kind of the obligation falls on the taxpayer. Now, not to be panicking, because I think what we should also realize that we're not talking about existing transactions. We're talking about new arrangements to be implemented after July this year, first step of implementation after July. But nevertheless, kind of the impact will be big. So one conclusion also to be reached is that the lecture of the professor and the visit of the industry fair are not covered by the hallmarks, even though they were identified as cross-border arrangements. So now to note one thing for completeness purposes only is that besides the individual reportable cross-border arrangements, intermediaries will face separate reporting obligations on marketable arrangements, and those are arrangements that can be implemented without substantial kind of changes being needed. This slide indicates what the marketable arrangements are and reflect the specific information to be reported. However, this part will only become relevant in 2020. So this finishes our discussion on the what question. And before we move into the who question, I would like to get your opinion on the retrospective effect that these measures will have until July or June this year. So now we have had a look at the hallmarks. We have an indication of the kind of arrangements that will have to be earmarked as of June, July this year for reporting in 2020. So please select one of the answers given on the retrospective effect. And that then moves us to the who needs to report question. And the first port of call when it comes to reporting is the intermediary. So Hanno, can you please explain who are regarded to be intermediaries and when these intermediaries will have to report?
Yeah, sure, Marlies. Thank you. Yeah, well, what is clear is that the primary responsibility to report rests with an intermediary. So the definition of intermediary is, of course, key. And if you look at the top half of this slide, you will see that this definition of intermediary is pretty broad, and it covers basically all those cases in which someone designs, markets, or provides advice in relation to one of those reportable arrangements that we have been discussing. So it's certainly wide enough to cover most situations, really, where an intermediary provides any kind of tax advice. But from what we know at present, it seems that it should not catch situations where the intermediary role is basically the one of just pure tax compliance or financial statement audit. As well, for an intermediary to have a reporting obligation, they also have to have some nexus to the EU. What this means is that for example, an intermediary outside of the EU will not have a reporting obligation. But it's important to note that intermediary may not have that obligation, but if him or her as well subcontracts part of the advice to an EU-based intermediary, that other EU-based intermediary may have to report. In cases when there is no intermediary or in the EU involved, the obligation to report will shift to the taxpayer. So what that really means is that these new rules will directly and indirectly also impact the companies or individuals to which the arrangements relate. So, and I think it's very important to note that there are certain situations in which the reporting obligation, as you said, Marlies, falls on the taxpayer. Those are, for example, the cases where the transaction or the planning idea is developed and implemented in-house. So the tax advisor of the company, for example, are developing or implemented any transaction or arrangement. Also, and as I said, when the advisor is outside of the EU, and therefore there is no intermediary in the meaning of the directive. And also in cases where the relationship between the advisor and the client is somehow protected by a legal professional privilege. And talking about this last one, this might be the case, for instance, in those countries where the intermediary is, for example, a law firm rather than an accountancy practice. And in these particular cases, though, where this waiver may be claimed, the intermediary will still need to be able to first identify the arrangements that fall within the directive, and this is because the directive requires them to inform the taxpayer of their disclosure obligations. And what that also means to me is that as well the intermediary will need to document and keep in its files that it has informed the client. And perhaps one final word on legal professional privilege. Some similar broader concepts and obligations exist in different countries. We typically refer to this as professional secrecy, and the directive is phrased quite narrowly. And so it will be interesting to see what happens and whether the reporting exemption will apply also to professional secrecy when national governments put this into local law.
Yes, Hannah, thanks. So a question that I have is whether a taxpayer is considered an intermediary or is there a separate distinguishable kind of reporting obligation for taxpayers?
Yes, Marlies, no, that's a good question. Yeah, the taxpayer is not an intermediary, and that's an important distinction. As I just mentioned, the intermediaries only need to report if they have nexus to the EU. But when looking into a taxpayer, on the other hand, this European Union nexus requirement does not apply.
So for example, let's see if I understand correctly. So if someone in the U.S., so say a U.S. law firm, advises on a cross-EU transaction to a U.S. taxpayer, and the transaction otherwise meets all the requirements for reporting, then the U.S. lawyer is excused, but the U.S. taxpayer needs to report. Is that correct?
Yeah, Marlies, that's exactly right. That is the way, or at least that's the way the wording seems to read. We will, of course, need to see what the domestic legislation in every country will look like, of course. But following your example, if that U.S. corporation does not report in these circumstances, it seems that it could be non-compliant. Yeah.
Yeah, thanks, Hanno. That's interesting. So now that we have spent some time on the triggers for reporting, let's take a look at what information the intermediary or the taxpayer has to provide to the tax authority. So Rink, can you take us through that?
Yeah, sure. Thanks, Maurice. So as you will see on the slide, on the left side, that is the information that the required information. First of all, it's not only about the visibility on the tax planning, but it's also actually the identity of the taxpayer. That's the first one. Other information is a description of the arrangement, and together with, of course, the hallmarks that are triggered. One thing is that there's also a requirement to identify the value of the cross-border arrangement, and that one, it's not clear what is meant by this at this moment. So if we then turn to the timing of when the disclosures need to be made, these are the trigger dates outlined on the slide, and there's a 30-day window from any of those dates. And as Stephanie mentioned before, arrangements that are captured by the retrospective effect, they will be reported between July 1st and August 1st of 2020. And all these time frames apply to taxpayers as well. So, and then the obligation to report sits with them. At this moment, and as also been said before, the EU has not provided any further interpretation guidance on this or anywhere else in the directive. There are some similarities coming from, for example, the UK regime, as Tom mentioned, and we are looking into what guidance can be taken and from that until further guidance has been made available.
So you refer to the UK guidance. So I'm still not sure what is meant by made available for implementation. And we also received questions on that. Does it, for example, require a detailed step plan? I know it is perceived to be unclear, but can we turn to another interpretation source to see whether we can get some kind of interpretation possibility? So Stephanie, can, for example, the UK explanation on their rules be helpful?
Yes, possibly. So the UK has had a domestic disclosure regime for some years now, and that phrase made available features in the UK rules. I would say, though, that the UK Tax Authority has put out substantial guidance on our regime. It's about 200 pages. So we have to hope that either the EU or member states will do likewise with this directive, just given the many uncertainties that, as you've mentioned, we're looking at, the lack of clarity. But if I look specifically at a UK context, made available for us means that all the elements necessary for the implementation of the scheme are in place, and that a communication has been made to a client suggesting they enter into it. Does that help?
Yes, that helps. Sorry, I forgot to press the mute button. So that indeed clarifies, Stephanie. So now we know what needs to be reported. I think the next question is who needs to report and when reporting needs to take place. So the next question is where the report needs to be filed after we have looked at the who and when. So Hanno, is there any guidance on this where question?
Yes, Marlies, definitely. Yeah, in the slides that you see on your screen now, you see the order of reporting if the intermediary or taxpayer needs to report in more than one member state. For example, that could happen if it has a taxable presence in multiple countries, such as in its country of residence and in a permanent establishment country. In these cases, in principle, reporting per taxpayer or intermediary will therefore only take place in just one member state. But this other slide then provides a second interpretation, and it gives the order of reporting when multiple intermediaries or taxpayers have to report on the same reportable arrangement. In this case, for taxpayer, the reporting obligation is, to me, relatively clearly narrowed down to one taxpayer, and this as long as the other taxpayers that may be involved provide proof that the reporting has taken place. But however, for intermediaries, the guidance is not, unfortunately, that clear, and it is indicated that in principle all intermediaries have to report. But however, it is also indicated that reporting does not have to take place if it is proven that reporting has taken place according to the domestic legislation of the member state of the reporter. As I said, it is not entirely clear whether this only covers the situation where the intermediaries are in the same country, or if it also covers situations where the intermediaries are in different countries. Although that interpretation would mean that many duplications would be prevented.
Yeah, Hannah, the possibility to ensure reporting by one central intermediary indeed seems efficient. And kind of looking at our polling questions, I think many, kind of 41% of the ones replying said, I'm not even sure this will have retrospective effect effectively, because taxpayers first need to know what they need to do, and we need interpretation, and we need to be informed. So that brings us to the question, what happens after it has been reported. So different from domestic mandatory disclosure regimes, the information will be exchanged on the basis of this directive. So Tom, can you explain how that works?
Sure, Marlies. So a key feature of this EU regime is that the reports are automatically exchanged on a quarterly basis among the member state governments. So this exchange is going to start taking place in October 2020, and the exchange will also capture the cross-border arrangements that are captured by the retrospective effect of the directive, so all the prior ones. It's important to note that this is not an advance ruling or clearance regime, that the directive explicitly states that just because the tax authority does not react to the information that's disclosed, one should not assume that they accept that the arrangements are effective or legitimate.
Yeah, so kind of there will be kind of exchange similar to rulings. So the directive also asks member states to introduce penalties. And what will these look like?
Well, the penalties have been left to the national governments to set. So with the directive simply providing some guidance to governments that those penalties should be effective, proportionate, and dissuasive. But apart from any specific penalties, of course, noncompliance may lead to significant reputational risk.
Yeah, thanks very much, Tom. So we now have a good overview, or as good as it gets, overview of what the directive will require. Looking at the scope of the reporting obligations, it indeed seems that the intermediaries and taxpayers can use some help in identifying, tagging, storing, and tracking the reportable cross-border arrangement that they will have to identify as of June or July this year. So, Rink, can technology help with it?
Yeah, of course it can. And I think that's some of the good news here, because with all the questions about the scope and the detailed implications of these developments, we are looking into developing a tool specifically for these MDR developments. Purpose would then obviously be to provide taxpayers a direction on what information needs to be disclosed and by whom it needs to be disclosed, and to which tax authority it needs to be disclosed, and if there are multiple or one or more intermediaries, then to keep track of what information is shared by whom. So we obviously are looking to include dashboards such as the screenshot that you can see here on the slides, which is mock-up, and that shows which intermediary is responsible for which hallmarks and also for which taxpayer, and whether the taxpayer itself is taking care of the disclosure. And obviously we distinguish then on the basis of the hallmarks, and other features are still being worked on at the moment, and no doubt that will develop over the coming months and years as we get more clarity on the directive and the implementation in national legislation. And when we get to the submission to the tax authorities, like I talked about earlier, then one thing to note is that in a lot of countries, to provide the content to the tax authorities, more and more the tax authorities require specialized, secure data transmission. That's not necessarily easy or cheap, as we've seen from other examples like the country-by-country reporting. So, given the complexity and the compliance burden that these MDR developments will bring, we as UI intend to put some serious effort in creating a methodology or a tool that clients and taxpayers can easily access and will help them manage their reporting obligations, as well as giving, of course, insight into the reporting obligations of intermediaries disclosing the information on their behalf.
Thanks very much, Rink. So that brings us to the final part of our webcast. I would like to ask thank everyone for their questions that they have posed. I think we're almost we're across the 60 minutes line, so we can't answer them, but we will come back to you. So this is a good place for a final polling question. So what impact will the directive, in your opinion, have on the tax environment? And please select one of the answers. So I would like to close off with 2 short takeaways. So as we have seen, the rules will have a relevant impact on the transparency environment. We need to keep in mind that it's not the only change that will have impact on transparency. We had a webcast on that in September last year. You can still watch it. And in this new era of transparency, it will have an important impact on the alignment of a company's tax policy with their commercial activities, on designing and retaining tax documentation, as Tom has already mentioned, on your communication strategy with stakeholders, and of course on your company's governance structure. As a second takeaway, I would like to stress, and we have mentioned it already a couple of times, the fact that this new directive will become relevant for intermediaries and for taxpayers as of June or July this year, given the retrospective effect that is required from member states. With that said, I would like to thank today's excellent panel for their contributions. As you will see on the screen, we have some excellent EY resources also available that can help you to both stay up to date with transparency development, but also to ask any responses on other questions. Thank you very much for joining us today. Before you sign off, please take a moment to open the red feedback icon and let us know what you thought of today's program. And if you have been with us for at least 15 minutes, responded to the polling questions, and also complete the feedback form, you can now download your education certificate by clicking the purple CPE icon at the bottom of this interface. I'm Marlies de Ruiter, and we've been bringing you news and insights from EY on the current corporate tax transparency landscape. Thank you for listening, and goodbye.